Hello, welcome back traders. And if you're new to this channel, welcome to my channel. And in today's video, I have an exciting topic that I'm going to discuss with you all and sharing with you the tools known as Greek and how to use it when it comes to trading option. So without further ado, let's jump right into it. Meet the Greeks. I love that name. This is part of the homepage of Option Playbook website that I basically use and also I read when I have time. And I think it's a good material to refer to when it comes to trading option. Remember, option is pretty complex. If you don't know, once you learn the language and basics, it becomes easier. At the end of the day, it's all about risk management. So it doesn't matter how much you know about the option. It doesn't matter how good you are with all those Greeks and especially all those strategy. It benefits you if you are a risk manager. So basically, at the end of the day, there is no guarantee. There is no one can say this is gonna go there. This is what's gonna happen. It's all prediction. It's all probability. And let's just not get too excited in terms of automation. So just learn it how to use the tools. So let's jump right into it, and hopefully that benefits you when it comes to trading option. So let's talk about delta. Beginners or beginning option traders sometimes assume that when the stock moves $1, the price of the options based on that the stock will move more than $1. That's a little bit silly when you really think about it. The option costs much less than the stock. So it is important to uh, have a realistic expectation about the price behavior of the option you trade. So the real question is how much the price of an option will move if the stock move $1. That's where the delta comes in. So that's exactly what delta does. Delta is the amount of the value of the option that would go up or down if the stock goes $1 up or down. If the stock is 150 or $150, for example, Apple. If Apple goes $1 up, 151, and the delta is 50 cent in that price, so your option would go up only 50 cent. So if you bought that option for $10, once $1 goes up, your option that you bought $10 becomes $10.50. So you made 50 cent. This has nothing to do with actual the price of the stock in terms of being the same. The movement or the impact. Delta is the amount an option price is expected to move based on the $1 change in the underlying stock. Gamma is the rate that delta will change based on $1 change in the stock price. A little confusing, but here is this. So if delta is the speed at which option price changes, you can think of gamma at the acceleration. So obviously when we buy a stock option with the delta, whatever delta is, if you choose the gamma, higher gamma, then you have a better chance that you make more money if the gamma is higher, because every dollar that moves, the speed of this option, which is delta, would increase as well as the value. So as we mentioned, delta is dynamic number that changes as the stock price changes, but the delta doesn't change at the same rate for every option based on the given stock. So let's take another look at our call option on XYZ, and the strike is 50 cents. To see how gamma reflects the change delta with the respect to change in the stock price and time until expiration. So this is the figure, right? So stock is at $48 and the delta is 32 cents. The stock goes up 49, $1 up. So the gamma is 8 and delta 32, this plus this 40, so it goes up 40, so 40 cents. That's how they explained it. And this is based on the delta 60 days. This is 1 day. That means in 60 days it is 2 cent move, which in 1 day is 0.1. So that's a very slow move for that stock. So every day, if that stock goes $1 up, we only gaining 1 cent. So plus 9 gamma, 10 cent. You see how important it is to choose the high gamma, because high gamma would increase on top of your delta. So now there is other one which is my favorite, and I really watch this whenever I want to choose an option to trade. Theta. What is theta? Theta decay, or theta is enemy number one for option buyer. So whenever you buy an option, this is the factor of your losing money over time. So let's see how do they explain it. On the other hand, it is usually the option seller's best friend. Of course, when they sell an option to you with the higher theta, they make more money every day goes by, or every minute goes by sometimes. Theta is the amount price of the calls and puts will decrease, at least in theory, for a 1 day changes in the time to expiration. So one thing um, I emphasize always when it comes to trading option, especially with 0 date to expiry. Let's say today the option expires. If you want to trade the 0 day expiry, you have to have a stop loss, and also you have to trade this for the first 1 hour of the market open. Otherwise the value goes really drastically down. Okay, so that's why you need to watch for theta. Now let's get to Vega. You can think of Vega as a Greek who is middle shaky and over caffeinated. Vega is the amount call and put prices will change. In theory, for corresponding 1 point change in implied volatility. Basically, Vega reflects by implied volatility, and that's what they are talking about, implied volatility, which is another factor to watch when you trade in options, especially for earning. Vega does not have any effect on intrinsic value of option. It only affects the time value of an option in price. Typically, as the implied volatility increases, the value of option will increase. That's because an increase in implied volatility suggests an increased range of potential movement for the stock. So there is another character or element in Greek. It's called rho, RHO, or whatever you want to read this. So what it does, this is not something short-term traders should care about, but it's good to know. Let's see what it is. If you are a more advanced option trader, you might have noticed you are missing a Greek rho. That's the amount of an option value will change in theory based on 1 percentage point change in the interest rate. So if you're a stock trader and if you're option trader with the short-term trading, doesn't apply to you. First of all, when you choose an option, the time to expiration is really important, especially if the direction is not predictable. So look at your chart. Nike been 105 not long ago, almost a couple of weeks ago, not even. Today 17, Nike was on first, like 17 days ago, $102. This is where I wish I had bought the Nike option, because look at how much it went, $14, $12 off. So if you bought the option here, you would have made so much money, right? Let's see how much we would have made. Let's say this is the 1st of August, right? We go to trade, and let's say next week, 6 days left, right? This option. So Nike is $113 now. Let's say when the option, let's say when the stock was at 102 or 103, we bought whatever option for this day. So how much would have made? Let's see what could have happened when if we bought. So that's why we go to quick chart, and then we pull up strike quick chart, and then we pull up the chart for that option. Best move happened on almost 3 days ago. 3 days ago, if you bought this, was 12 cents. It's been 12 to 23. It's been almost, it's basically 5x your price. 5x your price. Let's say you bought it in between. Let's say you bought it 20 cents. Now is, let's say $1. 20 cents, $1, 5 times, right? 5x. How many days? We would have had from 13 to pretty much 17. Or today's 17 market is called yesterday. Yesterday was 134. Okay, let's say you would sell it yesterday. We bought at 20 cents, we went to 120, 130. So it would be $1 profit. But you have to remember also 1, 2, 3 days. What was our theta? Remember, our theta is the amount of money that you would lose here based on every day passing by from the day that you bought it. So if you bought this 3 days ago, and let's say theta was, let's say 12 cents, and times 3, you would lose 36 cents. 36 cents minus $1, you would be still profitable, right? Because you bought at 20 plus 36 cents, 56 cents. You bought it for 56 cents after 3 days. That's how much it cost you. So you sold it at $1. Let's say you sold it at $1, not $1.20. So you would have made 40 cents approximately. So that's how the option will be calculated. So the longer you want, the longer option you choose, you have more likely to make more money if the direction of these prediction are in your favor. Because as you can see here, this is movement can happen or movement of the option predicted. So this movement for 6 days would be $2.85 up or down because nobody knows. That's what they predicted. And then it jumps to $9. So as you can see, this is a huge move. $2 to $9. That's the biggest move between those prices, right? $2 to $9, almost $7 move. We don't see any of these have a $7 move in between, right? Except this one, 18 to 23, that's 7, oh, it's $5. So but this is the biggest move. The reason why it's biggest move because Nike has earning in this week or prior to this day. Why is it gone up so much? Because Nike's implied volatility probably is going to be skyrocketing because of the earning. That's why you want to buy some option prior to the earning. And if you are directionally correct, you will be making or basically triple X in your option value. So when we select, we have to remember if any event is going to happen for the option or for that company or ticket. So I brought this example because we can tell this option will be way higher by this day, right? The movement of $9, what is it? 113 plus $9 and 40 cents, and here is, let's say, $10 move. It's almost $10 would be 123. So that would be our expected option value at that time if the direction is correct, right? Always choose the correct within the expected move. If you want to be in the money, basically, if you want to be owning the position or option that has more chance to be in the money, okay? As you can see here, probability out of the money, probability in the money. What are the chances? 123, right? 20% probability that is in the money, and probably out of the money is 80%, 82%, because of what they are 80%, because what they are predicting. But because of implied volatility is gonna go up prior to option, I mean a stock or company's earning, that would change dramatically. So this is why I have a position here. I have a vertical position for this stock, and I am hoping this is gonna go up because this is the expected move. So that's how you choose option. Always get the entry of your predicted calculated to the stock market price or stock price, $9.40 plus 113.50 or 60. So it's gonna be, let's say, 114 and 922.23. These are the 123 is the expected move, and it's $1.50. If you buy this option, you have most probability to be in the money than this one here and this one here. So that's why you want to be inside the predicted move. You want to be directionally correct. If you are, then you be profitable. So these are the stuff you want to look into when you buy an option. Remember also, consider you looking at your theta. 123, this 123 has a theta of 13 cent and delta is 23 cent. Always buy the theta less or least than your delta. That means every day goes by, you're losing 13 cent. Okay, so hopefully you guys enjoyed that video. If you have any question, let me know. I'll be happy to answer you guys. And if you haven't subscribed yet, please go ahead and join my channel. If you enjoyed that video, I appreciate if you give me a thumbs up, and also share the video, and make sure you check my channel again and turn your notification on. I will be talking about the Greek in a separate video for the whole Greek evaluation when it comes to choosing your option, because as I said, delta theta is the main important, but these two also impacts. So until next video and another session, I'll see you in my next video. Thanks a lot.